Stephen, what are you expecting on rates and how quickly might they rise?
I think with what we've seen on inflation and the labour market and what's happening in the global economy, we are set for a series of interest rate hikes through 2022 and probably into 2023 as well. My hunch is that we'll probably see the RBA hiking around about a percentage point through the course of this year, starting possibly as soon as May if the next inflation reading's high, but then continuing in the second half of the year with a 25 basis point rate hike virtually every other month. So we end the year around about 1%.
Now, that global inflation story is moving at pace, as we know. Last year, inflation was fuelled by the supply chain issues and those huge government stimulus programs that we saw all around the world. But we know now that these are being wound back. So what will fuel inflation over the next year?
Look, the interesting thing globally and domestically is the tightness in the labour market. I don't think any economist was really expecting the unemployment rate in the US to be below 4%, which it is. Same in the UK, New Zealand. Here in Australia, we're at 4.2%, and that's likely to go below 4% in coming months. So I think it's going to be the wages side of the economy that's going to substitute what was the very stimulatory monetary and fiscal policies that caused inflation to jump, and the supply chain issues too, to be sure. But I think we're now at this position where we're approaching full employment, that the workers are having an ability to extract high wage increases, and the way that firms cover their higher wages bill is to increase their selling prices, which by definition is inflation.
So do you expect that we'll see wages growth in 2022?
Look, I think so. All of the anecdotes that we're hearing about skill shortages, labour shortages are very real. And while we may have some offset as the borders reopen and immigration increases, particularly for skilled workers, I think that will not be enough to offset the fact that firms are looking to expand. They're looking for a range of workers, both the highly skilled IT people and that sort of style of employment, but also semi-skilled and low-skilled workers, the fruit pickers, for example. So I think that we're going to be seeing wage pressures building through the course of this year. The anecdotes, as I mentioned, on labour shortages are very real. We look at things like the job advertisement series, they're booming. And we look at the labour force numbers, we don't have that many people unemployed anymore. So the solution to that, 9 times out of 10, is that wages increase. And I think we're poised through the course of this year to see wages growth pick up from around about 2%, which is what it is now. And I think we're going to get very close to 4% by year end.
OK, if we are about to embark on rate tightenings and wage increases, etc., what are the immediate implications for assets? I mean, should we expect a 50% drop in share markets as predicted by renowned wealth manager Jeremy Grantham?
Oh, look, I don't think we're going to have the stock market crashes of that order of magnitude. There's so much wealth in the economy, and in a sense there'll be an offset to the asset allocation decisions, if you like, from investors moving their money into fixed income and away from stocks, for example, because the economy's strong. Firms make money when the economy is growing. Now, I know there's not a one-to-one correlation between economic growth and stock markets. In fact, there isn't. But to offset the concerns about higher interest rates and some of the volatility that we've clearly seen in stock markets in the last few weeks is the fact that the economy around the world, here in Australia, will be pretty strong, and firms that are agile, that are up to date with technology and these sorts of things, let alone the mining companies benefiting from this incredible boom in commodity prices, that our corporate world's going to be doing pretty well. And I think that that will support the stock market despite some of the headwinds that are going to be coming from tighter monetary policy.
What about housing then, Stephen? What do you think the impact of high rates will have on our housing market here?
Well, I think it's fair to say that the very low interest rates have been one of the factors that's helped support the housing market over recent years, and certainly over the last 18 months there's been this incredible surge in house prices. Now clearly that's going to be taken away, that it'll be not only a little bit harder to get credit, but when people put that higher interest rate into their mortgage calculator, they'll see that the repayments are going to be going up, and therefore their ability and willingness, more importantly, to borrow that extra $10,000, $50,000 to bid on a property won't be there. So I'm of the view that housing will weaken through the course of this year, that house prices will tend to be flattening, if not down in some parts. We've got to remember that there are very different housing markets from Perth to Darwin to Hobart to Sydney and Melbourne. So there will be differences from city to city. But I think on balance, the nationwide picture will be that house prices, having had a stunning run up over the last 18 months, are probably due for a pause and probably little or no growth. And in some cities, there might be small price falls.
We know, Stephen, it's an election year. What policy advice, economic advice, would you give to both parties on how they should campaign?
Look, I don't think they'd probably like what I've got to say, because I think that, as we've just discussed, that we've got this inflation pressure, we've got signs of economic overheating, and we've got clear evidence that the budget deficit is still huge. We're on track for $1 trillion of debt, as we keep hearing most days of the week. So, in a sense, if you're going to help take some of the pressure off the RBA and its hiking cycle, that there is a case building for budget repair. I don't think anybody would argue that the last couple of years we needed very stimulatory fiscal policy to help support the economy, but that's over. As we've just been discussing, unemployment's incredibly low. It didn't hit the 10% that Treasury were thinking. We're currently at 4.2%. So I think in the election year there will be some focus on economic management and the credentials of both sides on not only who's going to keep the economy growing, that's obviously very, very important, but who's going to be starting to repair this budget deficit and getting us back towards a balanced budget. That's going to be a tough decision for whoever wins the election in May, be it Jim Chalmers as Treasurer or Josh Frydenberg if he happens to fall across the line and remain as Treasurer after the election.
What do you make, Stephen, of the $420 billion spending war chest that the Treasurer is reminding us of? Is that enough to prop up the economy? Is this savings across the board or just amongst a certain cohort?
That $420 billion of household savings is a big number that we've been hunkered down, that we put our money aside, and it is something of a war chest that we can unleash when we're confident, when we're able to go about our business, travel freely, eat out and go to sporting events in numbers and all these sorts of things. So there is a lot of money sloshing around in savings accounts now ready to be put to use. But I think also one of the legacies of the COVID disaster, if we can call it that, is that people are a little more cautious. I don't think they're going to be running down all of that money in a hurry. And particularly if we get interest rate hikes, some of that money may be used to fund some of the mortgage repayment increases that are going to be coming through. So there's a whole lot of issues that make it not a lay down misère that some of that money will automatically go into spending. And particularly too, if we've got stock markets being biased a little bit weaker because of the rate hiking cycle too, people won't have that same wealth effect. So they'll be tending to hang on to that money a little bit more carefully. It's better to have it than not to have it, that's definitely the case, but I don't think it's the sort of magic bullet that's going to see the consumer side of the economy boom ahead.
Stephen Koukoulas, thanks for joining us.
Thank you.